Global economies and banking 2022. Now, we have seen the IMF projection. We all have important recognition that there's a definite reduction in terms of performance between 21 to 22. Recovery is on, but still we have to look at with cautious optimism. Trade still recovering, I should say. 7% is what we foresee, and we have reasons to believe global banks' balance sheet is reasonably in good shape. We have gone through the financial crisis in 2008 and 9, and lessons learned is important, and the accommodative monetary policy of various central banks and the government initiative in terms of fiscal are all great enablers for a bank's balance sheet reasonably in good shape. We think the banks will be stable and functional, but the risk is very important. One is high debt leverage. If you look at everyone is recognizing the corporate and government sectors results in higher corporate insolvencies and less government support for banks than anticipated. Now, this is world over. It's not a particular region alone. So now we are talking about unwinding the stimulus. Some countries are going to do gradually. There are some countries are still extending to support the business community. Banks are supported. Banks will support again the business. We also have the risk of disorderly reflation. We have a market disruption, inflation versus growth. We are seeing the contradiction. The economic recovery itself, we have cautious optimism. Property sector challenges, the stress in various parts of the world, including China, and spiking housing prices in many markets. So all sort of combination we are witnessing. It varies from jurisdiction to jurisdiction, but we have to understand that it's going to be a stress and deflection in terms of valuation and the overall rental receipts. Demand versus supply needs to be looked at. When it comes to interest rate, lower rates, environment and fintech evolution challenge the banking business more. And that has to be now looked at objectively. Will the economic recovery will continue? Will the inflation help the net interest margin? What will happen to the non-performing book? Well, the overall over-leveraging, which I mentioned to you as a key risk, will it impact the banks? How much the property prices will impact? So, if you look at the major aspects in terms of credit, asset quality and profitability is very important. Second aspect which is coming up very clearly is the ESG, environmental social governance programs. That plays a big role. That's social risk management. We have to look at it. When it comes to asset quality, rates will remain low despite the inflationary pressures. Economic rebound will assist in demanding for credit. Consolidation as a way to reduce overcapacity to improve efficiency. That's possible. Everyone will go for digitization. You have less choice. Customers are demanding. Technology plays a very big role. Cyber risk and anti-financial crime is going to be mounting, and we have to fix it, map it. Digitization of the ecosystems continues to expand. Work from home, big data, artificial intelligence, these are all going to be dominant. More investment is needed to respond to the changing customer preferences. When it comes to regulation, use of regulatory buffers, path, and we have to understand speeding up the regulation to normalization is very, very delicate task. Resolution versus government support is important. How much government is going to support? Unwinding of various forms of support by public authorities. When it comes to stronger for longer inflation will weigh on the economies. So Meanwhile, digital transformation happening in a big way. The business model will be the difference between failure and success. Acceleration of digital transformation, cashless economies, shift in business models, cloud stand for use, payment segments, spotlight on blockchain solutions, and regulators will push for digital transformation. They are going to push because that will create more confidence in them. Traditional finance versus a decentralization in terms of finance. It's a new concept. That is a new system that uses smart contracts to blockchain instead of central financial intermediaries to offer financial products and services, driving the change and introducing new era of economic reorganization, I should say. We have to look at traditional players will die down. We have to understand new client needs, new workflows, new transaction frameworks, reshaping the risk parameters, removing the intermediaries. Very vital. Tech disruptions also risk for all banks, and equally so. Intervention. If you look at the government side, they are going to intervene. Regulators globally ease rules and guidance to soften the pro-cyclical effects and spur banking lending. So far, that was only to soften the pro-cyclical effects. Now we need a regulatory reform agenda because we can't keep it on hold. But deadline, FSB, Financial Stability Board, has pushed back. Now, we are also seeing a risk of widening cracks in the regulatory consensus. Everyone has got a different spell. We need to unify them and then come to terms. So they can fix, they can also be flexible. Prudent measures to respond to COVID, how they will do it. You have to delay the implementation of the latest revision of Basel III capital rules. Again, Basel IV. Transition arrangements for expected credit loss accounting is equally important. Greater flexibility in classification and risk weighting apply to forborne loans. Relaxation of counter-cyclical buffers. When it comes to bigger picture, the outlook will change. Could this a permanent one? Perhaps yes. So public support is really, really important. Enduring role of public support. COVID-19, we need to make sure banks have benefited from the public authorities, indirect and direct support. Mixed picture. Financing conditions remain broadly supportive, but inflation is biting. We have to expect the bank asset quality deterioration to continue in some countries. Not all. Credit conditions around the world are changing. When it comes to key countries, if you look at even US for that matter, revenues or expenses or profitability or credit quality or capital or funding and liquidity has got a very important change. So every country in the world have to look at the expectations, key assumptions, key risk in the market specifics, and then come to terms. Profit will rise a bit but remain structurally low. Very important point. Nowhere the profit can be exponentially moving up. It means something wrong. So you cannot make it happen. Shareholders' remuneration will change. Capital will remain solid. Now, intellectual property become the biggest one. When it comes to emerging markets, it is very important. Economies are recovering. Credit loss will gradually decline. Asset quality is stabilizing. And investor sentiments will change. We need to understand the dynamics of it. We have to net banking external debt as a percentage of system-wide domestic loans. External debt, we have to bring it down. So how do you increase the big picture? Credit conditions, Asia Pacific, GDP expectations, Asia Pacific factors, key expectations, key assumptions, key risk. We have to look at it. Credit losses to decline for most jurisdictions as the economic recovery takes hold. When it comes to big picture, you have to understand each market dynamics, growth versus the risk. We have to measure it. So different parts of the world have different spell out. So each market you have to look at objectively and then come to terms, whether there is excess liquidity, whether there are profit constraints, and how long the loans under moratorium remains a latent risk. It's an important analysis. Heavy duty bad loans cleanup will happen. Provisioning and capital buffers are strengthening. Government supports are required when it comes to non-performing. The big picture is, as far as the Asia Pacific is concerned, the GDP is going to grow. That's a bigger opportunity. Manageable provisioning ahead, but lending growth only marginally higher than pre-pandemic. It's not something will change. As every market disruption will have consequential impact in terms of the asset bubbles, challenges from the inflationary side, and also the demand side will have a consequential impact in the big picture. So regulators have to work together and make sure risk for all banks, at the same time shaping up the markets is in the hands of monetary policy and the fiscal policy. Traditional finance versus decentralized finance is a bigger opportunity. We have to look at it, factor the digital transformation, looking at interest rates, looking at the the factors which are driving the credit worthiness, and the key risk which I mentioned are all vital to see through. We have a good opportunity for us to measure, manage and control with cautious optimism for economies as well as the banks in 2022.